Okay, let's dive in. We're looking at Magic Software Enterprise, ticker MGIC.
Right. Specifically, their first quarter 2025 results.
And, these earnings calls, they're just packed with information. Numbers, commentary.
Oh, absolutely. It's a huge amount of data to sift through reports, the call transcript itself. Finding the really important stuff can be tricky.
But that's what this deep dive is all about, really. We want to cut through that noise.
Yep. Take what the company actually said about Q1, pull out the key insights.
Exactly. Give you a clear picture of their performance, their outlook, based on their own communications.
Kind of guide you through the signals, you could say.
So let's start at the top. The headline figures. Magic Software reported record revenue for Q1 2025.
That's the big one right away. $147.3 million for the quarter. A new record.
And not just flat either. That's up, about 12.7% compared to Q1 last year?
Correct. So record revenue, pretty decent year-over-year growth.
Okay, and further down the statement, net income.
Non-GAAP net income attributed to controlling interest, that also saw an increase. It hit $2.4 million.
Compared to $1.6 million in the same quarter last year.
Right. So that's moving in the right direction.
And that feeds into earnings per share, obviously.
Yeah, non-GAAP net income per share was up 8.3%, came in at 25 cents per fully diluted share.
Up from 23 cents in Q1 2024.
So you look at those headlines, record revenue, higher net income, better EPS. It all looks pretty positive.
But like always, the headlines only tell part of the story, right? We need to dig a bit deeper.
Exactly. What's actually driving those numbers? What are the underlying dynamics? That's where the interesting stuff is.
Which brings us right into the financials and operations. Let's break down that record. $147.3 million revenue. Where's it coming from?
Geographically, Israel was the biggest piece. That accounted for 47% of the total revenue.
Okay, 47%. So how much was that in dollar terms?
$69.9 million from Israel. North America was next at 40%, which is $58.7 million.
Right, so Israel is the larger segment, and it sounds like it performed really well.
Extremely well. Revenue there was up 17.7% year over year. That's quite strong.
Wow. And did they say what was driving that growth in Israel?
Yeah, they pointed to a few things. Strong demand for cloud services, DevOps, and importantly, AI services.
AI, okay.
And also continued strength they're seeing in the defense sector over there.
And crucially, was this growth bought or earned?
Mostly earned. They specifically said over 80% of that Israeli growth was organic.
That's significant. Tells you the core business there is humming. Now, North America also grew, right? 11.1%.
It did, but there's a key clarification there. That growth came entirely from an acquisition theories, which they bought back in April 2024.
Ah, okay. So if you strip out that acquisition.
Excluding theories, revenues in North America were basically stable year over year, flat.
So a very different picture. Organic strength in Israel, acquisition-driven growth in North America. What's their take on the U.S. market itself?
Management's commentary was cautious but hopeful, maybe. They said the U.S. market has yet to show a full recovery.
Okay, still lagging a bit.
But they do anticipate some positive momentum building, potentially linked to the broader economy improving later in the year.
Any green shoots?
They did mention starting to see, quote, rising deals flowing in from their existing customer base there. They see that as a positive sign for maybe some expansion in the second half of 25.
Okay, so a nuanced geographic story. Israel strong organically, North America propped up by M&A, U.S. showing maybe early signs of life. Let's shift to profitability. Non-GAAP gross margin was 28.5%.
Yeah, and that was actually down a bit for Q1 last year, which was 29.3%.
Which, given the record revenue, seems a little odd at first glance. What was the reason?
They gave two main reasons. One was the revenue mix, the split between software and professional services.
Right, software usually has much higher margins.
Exactly. But the bigger factor, they said, was the timing of their term software license renewals.
Ah, timing. How so?
Basically, in 2025, the big high-margin software renewals are heavily weighted towards Q4 and some in Q3. Whereas in 2024, those renewals were more spread out, with more hitting in Q1 and Q2.
Got it. So software margin itself is still high, like 62% in Q1 25?
Yeah, compared to about 21.5% for professional services. So fewer of those high margin deals landing in Q1 just pulls the overall average down for the quarter.
And the mix itself was slightly less favorable too, you mentioned?
Just slightly. Q1 25 was about 17% software, 83% services versus 18% and 82% the year before. So mostly the timing issue.
Makes sense. And they expect this to correct itself.
Yes, they expect gross margins to improve as the year goes on, getting back over 29%, maybe 29.1, 29.2%.
And importantly, despite that percentage dip in gross margin, what happened with operating income in dollar terms?
That still went up. Non-GAAP operating income increased by 1.9% year over year to $18.5 million.
Okay, that's a critical point. Margin percentage down due to timing, but actual operating profit dollars still grew. Let's look at financial health. Financial expenses came down quite a bit.
Yeah, that was a positive highlight. Down to $600,000 in Q1 25 from $1.5 million in Q1 24.
And the reason?
They said it was mainly due to them continuing to pay down their financial debt.
And the debt numbers back that up.
They do. Total financial debt was about $56.3 million at the end of March 2025.
Which is down from?
Down from $59.3 million at the end of 2024, and significantly down from $78 million a year prior, end of March 2024. So definite deleveraging happening.
Okay, deleveraging is good. But then we look at cash flow from operations.
Mm-hmm.
And that saw a pretty noticeable drop.
It did. $14.9 million in Q1 25, which is quite a bit lower than the $27.7 million in Q1 24.
And even looking at the trailing 12 months, it's down compared to the full year 2024 number.
Right. $62.1 million for the LTM ending March 25 versus $74.8 million for the year ended August 24.
For a record revenue quarter, you see that operational cash flow number drop, and it could raise an eyebrow. What did management say?
Their explanation was that it primarily reflects increased investment in working capital. Meaning, as they grow revenue really fast, they need to put more cash into things like accounts receivable money owed by customers for work already done.
Right, you deliver the service, generate the revenue on paper, but you haven't collected the cash yet.
Exactly. So they framed it as funding the growth. They need to make these investments to support that record revenue trajectory.
So the argument is, don't worry, it's not poor performance, it's just the cost of growing quickly right now.
That's precisely what they argued. They emphasized it does not reflect deteriorating underlying performance. And they pointed to the fact that operating income and net income were actually up as proof.
And they expect this to normalize.
Yeah, they expect cash conversion, how fast revenue turns into actual cash, to normalize in the coming quarters as they collect on those receivables.
It is worth noting, though, the overall cash balance took a big hit.
True. Cash and equivalents were down to about $15 million at the end of March, compared to $112 million at the end of December.
That's a huge drop, more than just working capital.
Yes. A big chunk of that was due to significant dividend payments they made early in the year. Over $27 million, I think.
Ah, okay. So they used the cash built up at year-end 2024 to return capital to shareholders, and then there's the working capital impact on top of that.
Correct. The dividend payment explains a large part of the overall cash reduction.
Okay, let's pivot now. Strategy, outlook. What's the forward-looking picture? They talked a lot about AI, right?
A lot, especially generative AI. They're really positioning themselves as helping companies figure out how to actually use Gen AI effectively.
Any specifics on their activity there?
They threw out some numbers, involved in over 200 Gen AI projects across more than 20 industries.
Wow, okay.
And they have a dedicated team of, I think, over 30 specialists focused just on this.
And here's the number that really caught my eye from their comments. They claimed a 62% success rate for Gen AI projects.
Yeah, that was striking. And they define success as going from the initial proof of concept all the way to full-scale production deployment.
62%. And they contrasted that with
an industry average they cited as being only around 12%.
12%. So if their 62% number is anywhere near accurate,
it suggests they might be significantly better at actually getting these complex AI projects over the finish line compared to, well, maybe the average provider. Could be a real differentiator.
They also mentioned doing a lot of events, partnerships.
Yeah, over 100 AI-focused events, more than 10 strategic partnerships in the AI space to support this push.
And they tied this into their base in Israel.
They did. Mentioned Israel's high global ranking for AI investment and R&D. You know, something like 25% of Israeli tech firms being AI companies.
So they see it as a natural fit, leveraging local expertise.
Exactly. And they also brought up the Israeli government's big AI leadership program and noted that Matrix IT, the potential merger partner, has a large footprint in that public sector space already.
Okay, speaking of the future, what about guidance for the rest of 2025?
They reiterated their full-year revenue guidance, kept it the same,
Which was?
in the range of $593 million to $603 million, which implies, year-over-year growth between 7.3% and 9.1% for the full year.
So, still expecting solid growth for the year overall. But they did flag a specific issue for Q2, didn't they?
Yes, a temporary headwind. It's purely calendar-driven. Because of the timing of the Passover holiday in Israel this year,
Right.
Q2 will have about 4.5 fewer billable days in their Israeli operations compared to Q1.
That sounds significant. How much impact?
They estimated it's about a 7% reduction in their time and material billable capacity in Israel for that quarter.
Okay, so a temporary hit, potentially variable, maybe they can mitigate some of it.
Exactly. Just something to be aware of for Q2 results specifically.
And then the elephant in the room, the potential merger with Matrix IT.
Right, the big strategic overlay. They signed a memorandum of understanding, an MOU, back in March.
For a merger where Magic would essentially be absorbed into Matrix.
That's the plan.
And the timeline they mentioned on the call was interesting.
Yeah, they said they anticipated completion during the first quarter of 2025.
Which was the quarter they were reporting on.
Exactly. So either the process is very far along, or perhaps there was a slight slip from internal targets by the time they held the call. They did say they're currently advancing through the execution phase.
Okay, so it's moving forward. And the strategic thinking behind this. Why merge?
The rationale they gave is pretty standard for this kind of deal. Combine strengths, create a bigger, more diversified global IT service provider.
Scale, resilience.
Enhanced capabilities, faster innovation, better long-term value. They think the combined company can reach more customers, offer more services, expand geographically.
And you mentioned the potential in the Israeli public sector specifically.
Yeah, they called that out as an opportunity for the combined entity, leveraging Matrix's existing footprint there.
Okay, so let's try and pull this all together. What's the narrative emerging from this quarter for Magic Software?
Well, you've got record revenue, which is great, but that growth is geographically lopsided. Very strong organically in Israel, fueled by hot areas like AI and defense.
While North America's growth was entirely from an acquisition, and the core U.S. market is still, let's say, recovering.
Right. Then you have the profitability picture. Gross margin percentage dipped, operating cash flow dipped.
But with specific explanations provided by management.
Exactly. Margin dip due to timing of high-value software renewals expected to reverse later in the year. Cash flow dip explained as investment in working capital to fuel the top-line growth, also expected to normalize.
And importantly, operating income dollars still grew despite the margin percentage dip.
Correct. And the debt levels are coming down.
Then there's the strategic push into AI, where they're claiming this really high success rate.
That 62% number,
Yeah.
if that holds true, it could be huge for them. Suggests they're really good at operationalizing AI for businesses, which is a major challenge for many.
And all of this is happening while they're pursuing this potentially transformative merger with Matrix IT.
Which seems aimed at achieving scale, diversification, and leveraging combined strengths, especially in their home market of Israel. It feels like a logical step to consolidate and grow, rather than a pivot away from their core focus.
Okay, now this is the deep dive, and we need to be crystal clear. Nothing we discuss here constitutes financial advice. We're simply analyzing the information the company itself put out there.
Absolutely. But purely for discussion, if you were a hypothetical analyst trying to be creative based only on these very specific details from the call, you could maybe come up with some interesting, if highly speculative, trade ideas.
Okay, let's hear one purely hypothetical scenario.
Well, given the stark difference in performance, strong organic growth in Israel, almost half the revenue, driven by AI and defense versus the flatter organic picture in the US, you could theoretically construct a geographic pair trade.
How would that work?
You might hypothetically go long MGIC stock or calls, betting specifically on that Israeli strength continuing to drive results. And maybe, just maybe, you'd hedge that by shorting a basket of IT service peers who are more US-centric and whose management commentaries may be less optimistic about the US recovery, sort of betting on that regional divergence continuing.
Interesting. Purely playing the regional strengths described in the call. Okay, give me another hypothetical one.
Another idea could play purely on the timing factors they disclosed. Q2 has that Passover headwind impacting Israeli billable days, and Q1 had the working capital investment hitting cash flow.
Right.
So theoretically, you might consider a short position or buying puts on MGIC expiring late Q2, anticipating potential temporary pressure on those Q2 financials. But simultaneously, you'd establish a long position or buy calls expiring later, say Q4.
By Q4.
Because they explicitly said the high-margin software renewals are concentrated in Q3 and especially Q4, which should boost profitability then. Plus, they expect cash conversion to normalize. So you're betting on a temporary dip followed by a later recovery based purely on the operational and financial timing they laid out.
A calendar trade, essentially, based on their own quarterly expectation.
Exactly, playing the disclosed timing.
Okay, but let me hammer this home again. These are completely hypothetical scenarios, speculative ideas for discussion purposes only, based solely on the earnings call details. This is absolutely not financial advice. Don't trade based on this.
Emphatically not financial advice. So wrapping up, Magic Software's Q1 showed record revenue driven by specific segments in Israel. Profitability dynamics were impacted by timing issues they expect to resolve.
They have a major strategic focus on AI, with some impressive claims about their success rate there, and of course the big potential merger with Matrix IT is progressing.
Hopefully this deep dive has helped you get beyond just the headline numbers and understand the specific drivers, the challenges, and the strategic moves Magic Software talked about themselves.
And for the very last time, none of this was financial advice.
Not a bit.
But maybe something to think about. Given that reported 62% success rate in GenAI projects, their focus there, and the potential scale and public sector access from merging with Matrix IT, does this earnings report maybe hint that Magic Software could be positioning itself to really capitalize on the enterprise AI wave in a way that the current financials might only just be starting to reflect?